when you look at a lot of successful artists, part of the reason why they take that label deal or that secondary advance is that they have to pay off some of their taxes, or they have some liabilities, or they're refinancing their home and they need to put down more money for equity on a property, right? So I would say that, I think a lot of common mistakes is taking that advance money, not tax planning from day one.
Mm.
And then when it comes to year end, it's like, surprise, surprise, the IRS this year wants to collect. And I think what a business manager is supposed to do is just sort of, set that expectation up front that, hey, like, if you're making money, you're paying taxes. A lot of people think that's a bad problem. And also no one wants to pay taxes, but it just shows the government that you're actually making money, right?
Mm-hmm.
So it's like a weird thing where it's like paying taxes just is a catalyst that you're making some money.
Welcome to the Manager's Playbook, featuring Dan Gonzalez. Dan Gonzalez, what's going on, man?
What's going on, brother? How are you?
I'm doing good, bro. I'm doing good. We got a lot to talk about here.
Yeah, both good to be in Toronto doing this,
Yes, absolutely. Listen, for those who don't know, you're a business manager in the music business, 29 years of age, up and coming, crushing it. I want to get right to it, man. What does a business manager in the music business actually do?
Yeah, I think, the term business manager itself has evolved so much, but historically it's kind of been the finance function of the artists, producers, songwriters, executives, back office. Historically, it started off as, taxes, bill payment, year-end taxes. But I think the role itself has evolved so much with, music becoming an institutional asset class.
Yeah. And so on that front, so talk to me a little bit more of how much it's evolved, because you said there's ledgers of taxes, and now it's gone into this like place where we are talking as an asset class.
Mm-hmm.
There is capital coming in from a lot of places, because it's not just based off of retail transactions.
Well, I'll say this, like, music has historically been very centralized.
Yeah.
Now we're at a point where it's so decentralized.
Yeah.
Right? Before it was labels paying out artists. Now you have artists distributing themselves paying out producers and songwriters, right?
Right.
So the layers of complexity have evolved significantly, because if you look like 30, 40 years ago, you had touring, that was sort of the settlements. You had the labels paying out artists, producers. But you fast forward 30, 40 years where artists are, streaming independently. So now they're paying out people.
Mm-hmm.
So you need to invest in that sort of back office functionality, because it's become so much more than just paying out people and just doing taxes.
Okay, so what's the difference between a business manager and an artist manager?
I would say artists will primarily focus on the creative aspect of the artist's trajectory, right?
Mm-hmm.
And I would say that the business manager is kind of that sort of intermediary function, because the artist and the artist manager and the artist have a unique relationship, because you want to have that intermediary that controls finances to make sure that there's someone independent there verifying funds and making sure payouts are done correctly.
Mm-hmm, mm-hmm. And so now when you talk about the back office piece,
mm-hmm.
let's go into that a little bit deeper. What does that actually mean?
So I say back office is essentially saying like, what is your finance infrastructure, right? In this business, as you know, it's notorious, even when you're dealing with the big labels, it's notoriously hard to even like onboard to a UMG portal or a Warner portal. It's kind of like legalese.
Uniport?
Yeah, it's like legalese for, artist managers. An artist manager's worst nightmare. It's an artist's worst nightmare.
Yeah.
I think, the business manager is that person that just has, the patience and just the true understanding to make sure that, your W-8s are updated correctly, your W-9s are done correctly, if you depending on what your jurisdiction is, and just doing all that sort of tedious work on the back end to make sure that money is flowing, legally and also in a cohesive way.
But are you doing that just like, does a business manager come with a team? Is it just one person? How are you able to do that if you have a bunch of different clients? Because, you have a few clients, one of them being myself.
Yeah, and exactly. No, I think, historically you've had these mass market shops that essentially cater towards, a lot of, high profile clientele, but there is kind of the emergence of like, I would say like the independent business manager where I've gone more boutique. Like my strategy isn't to have 20, 30 clients. I want to pick 5, 10 clients that I want to grow with and actually, measure the success of our relationship over the course of 5, 10 years.
Mm-hmm.
Whereas I think even in a traditional business management shop, it's more corporate-y and you don't have that necessarily same one-on-one experience and sort of tailored experience. So, there's two models to it. I think the model that I'm pursuing is more a la carte, where it's more a service-based approach. And I kind of look at each independent client needs and be like, engage with it, because, you might start off with a business manager just to pay bills, but, 5 years down the line, it's a lot more cohesive. You're doing ventures, you're raising capital, you're assigning assets over to the right entities. You're managing cross-border tax if you're a Canadian artist that, is from Canada, but also performs in the US, right? So it's a lot more cohesive as you develop that relationship. But starting, it's like just, traditional paying taxes, making sure you pay vendors and bookkeeping.
When you say assign assets to the right entities, what does that mean?
So I would say like, a perfect example is like, an artist starts off with, himself. He starts earning income by himself. He becomes more mature. He has some money flowing. Typically a business manager is like, hey, it would be good to sort of set up a company, an LLC, a corporation. So now your music is, being earned through that loan out company or LLC. But then you also have brand deals. You also have publishing. You also have merch. And now you're pooling all of these revenue sources into one company. But as you develop and you get more mature, there's a lot of risk associated with meshing all those assets or sort of revenue streams into one company. So then you start setting up additional companies.
What are those risks?
So for example, a risk would be like, let's say you wanted to do a label venture.
Yeah.
You wouldn't want your merch business, or you wouldn't want your brand business or publishing business to be commingled with that asset. You would essentially want to set up an independent label business just to make sure that all the money goes to there and all label/partner businesses flow through that specific entity.
All right, listen up, guys. Gonna have to take a quick break from the podcast because I want to talk to you about your music rollouts. Listen, most artists fail because they don't have a plan for their music. There's no strategy, no timeline, no idea what to do after the song drops. That's where Venice Music comes in. Venice is built to help independent artists release music the right way with guidance at every step. They create personalized rollout strategies based on the artist's goals, timeline, and release. They handle global distribution to every single major platform, and they offer the best customer support in the game. Now, this is real people you can actually talk to when you need help. It's not just about getting your music out. It's never been about just getting your music out. It's about doing it with intention, backed by a strategy that makes every move count. So if you or your artist is gearing up to release, don't just upload and hope. You got to go to Venice Music and get your free personalized rollout strategy. We'll also have a link in the description below for you to check it out. Now let's get back to the pod.
So when you're saying that and you're separating these entities, is it all going under one holdings? How does somebody actually do that?
I think in a super mature, super high level is like you have a trust, which owns your holdco.
What's a trust?
So trust is a vehicle that, a lot of, successful artists, actors, it's kind of like the final form of structure where they essentially have a trust which has a beneficiary to essentially look over the client's assets as a whole.
Mm-hmm.
And it flows there as well because there's also a lot of tax benefits as well. So.
Mm-hmm. And okay, sorry. So you're saying, so if you have a mature company, you set up a trust and then?
You set up a holding co.
Yeah.
So the holding co is like, you look at artist holdco, and that's kind of where all the revenue flows up to that company.
Okay.
And then within your holdco, which is called like your parent company, like a traditional setting, you'd have, holdco, you would have operating company for the label.
Yeah.
So that operating company just earns all your label income. And then you would have an operating company for your publishing if you wanted to even further, separate that asset. So you would have a publishing co. Then you would have a merch division, right?
Mm-hmm.
Or you would have a touring company. And essentially you set up all of these different operating companies to just limit exposure because, for example, the touring business in itself is a very high risk business. Things happen, insurance, claims, et cetera. So you want to make sure you limit that liability, for example.
So let's take the A Till Faint as an example, as a real life example of what we've been doing. It's obviously not matured at a massive level, but what have we been doing here? Just to give an example. And I'm okay to put my business out there.
Yeah, no.
Not revenues and numbers over here.
Yeah, no, I think when I look at your business and what we're working on right now too, I think a big part of it is just setting up the lay of the land for you to succeed in 5 years, right?
Mm-hmm.
A Till Faint would essentially be your parent company, right? It's currently the company that is contracted to service all your revenues, but your revenue streams have become so diversified. You do consulting, you do
management,
sponsorship,
ad revenue,
and even this podcast, right?
Yeah.
So you necessarily, when you're looking to work with, a future partner, for example, right? If you're working on a podcast deal, you wouldn't want that deal to be done with the parent company, of which also holds the assets of all of your other revenue streams, right? You would want to silo that.
Mhm.
So that's what we're working on right now, where we're creating another company which would essentially own the IP of, your podcast.
And I asked that because, in this business, a lot of people don't really know what a business manager does. And what I've been looking for is somebody like you to actually help me with the strategy.
Yeah.
Not me go and ask the questions, but somebody like you to actually be like, yo, have you been thinking about things this way and that way? And intuitively, I've learned, I get it and I understand it, and I've had to learn it over the years, right? But to action on that and execute on that, I think a lot of people think that an accountant is supposed to do that. Or like sometimes a lot of people in this music business just believe that the business manager is the accountant.
Yeah.
Tell me the difference between that, because there's a lot of that in this business and people seem to get fucked over, for lack of a better word, over and over in this area.
Yeah, I would say like a lot of accountants are business managers, but a business manager is not necessarily an accountant.
Okay.
So, there's a lot of CPAs who become business managers. I mean, I have an accounting degree. I don't have my CPA, but, I'm an accountant by sort of trade, what I studied at school. But I think there's this expectation that, when you work with someone that's just doing accounting functionality, that you also expect them to do the strategy work. Like accounting is more of a compliance function, right? Compliance and tax optimization.
Yeah.
I think the business manager or an effective business manager essentially uses that information to make strategic decisions and strategy. So it's more forward looking.
Yeah. Okay. That's pretty simplified. Can you give me a bit more of a general kind of so like if an artist is, well, better yet, what's his question? When does an artist seek out an accountant or a business manager?
Yeah, I think the step number one is that obviously when you're, let's take the artist who gets their label advance, right? 100K, 200K, 300K, that ultimately has to be reported to the IRS if you're in the US, CRA if you're in Canada, right? Now, you realize that, I think the first trigger for an artist is that tax bill, that first tax bill. They go to their accountant, they get that 100, 200K advance, and then they realize they have a tax liability owing. And then that kind of triggers, hey, you should open up, an LLC or a corporate structure to sort of flow through that, So that's kind of like the evolution or the trigger for the artist to be like, well, I think I need some sort of back office functionality.
If you don't mind, I stop you there. Like, so what that means is, say you get $1 million advance, right? Or just even smaller. Say you get the $200,000 advance, right? You should know that half of that advance, you pay the taxes.
Yeah, it's interesting because it's a couple of things, right? Like, Canada is a high taxed, sort of country, but so is California and New York.
Yeah,
right?
yeah.
So, there's even a broader thing. Like, even within the US, tax is so complicated because it's based off where your residency is, right? So a lot of people have moved to Florida, for example, to sort of take advantage of the no state tax, for example.
Yeah, yeah.
Right?
Texas has that too, right?
Texas has no state tax as well, right? And it's becoming a real phenomenon. Like all the big hedge funds are moving down to, Florida, Miami specifically, and essentially building around that sort of tax benefit, right? But I think, just having the network or the accountant to even support you even prior to going to those label deals, it's important because you could set up a structure before you take that advance and structure in a way that's most tax efficient.
Yeah. Okay, so if you're doing a $200,000 advance and you got yourself set up in Florida, how much are you paying in taxes on that? How does that work?
If you just claim that income as a whole, you pay, probably paying in the higher tax bracket, right? Which will kind of be anywhere from 35 to even 50%, depending on where your jurisdiction is. Because in Canada, like anything over 250, you're being taxed at like 53%.
Yeah.
Right? So
on your personal,
right?
Yeah.
But, I think where a business manager would come in, it's like, hey, yes, you're getting this 200K advance, but guess what? You have a bunch of these expenses. You have travel, you have T&E, you have flights, you have wardrobe. All of these, expenses are, you can write it off, right? So essentially reduces your taxable income. So if you were to claim the whole 200K personally, you're paying at the highest tax brackets. But if you put it to the right structure, you're able to write off costs before you even claim that income. And I think that's like, a cool fun fact that, most artists should know.
Right. So So then, does it make sense if a rapper wants to go and buy a chain for $40,000 or $50,000 off of their advance that's a good expense because
Well,
you
then
can write that off?
that's where the IRS gets. That's where the IRS gets, even more complicated, because as long as there's a professional and business need, you can make that argument, right? But at the same time, that's where also a specialized accountant comes into play, because a business manager is kind of like the project manager connecting the dots. It's like, okay, if you're in the podcast business and your name and likeness is important, wardrobe is important, right?
Yeah.
If I'm a business manager, I'm behind closed doors, me buying a Rolex, and I can't write that off because it's not for a business need.
Right. But so now, would you recommend that though? If you get a $200,000 advance for an artist to go and buy a nice Rolex or a nice chain, like what are you recommending? Because to me, that doesn't make any sense. I get it that you have to you have to keep up appearances, but
yeah, and there's other ways to do it. You can use it in videos. You can rent it out. There's so many. It becomes like your outfits and stuff has been so commoditized that it's like there's literally services that provide the Rolexes, the cash, the chain.
Right.
When people do like the Met Gala, they literally just rent it from a jeweler, right?
Yeah.
But I would say, I think when you take that capital, and I think most artists don't truly realize the cost of that capital, right? Because, if you're taking $200,000-300K, but the servicing cost on that is 80-20, where it's 80% the label and 20%, the artist in the traditional label deal, for example, it's like you essentially have to recoup 4 or 5x of that amount before you even see a single dollar, right?
Break that down, simplify that so people can understand what that means, because it's come up in the podcast a couple of times, but I want to make sure that it's coming from a professional like yourself.
So, and let's use $100,000, right? as a nominal number, right? An artist signs for $100K for, let's say, 4 projects. Each one has an option. So $100K, $150K, $200K, $250K, because they're stepped up, if you get to that level. If you take that $100K, essentially the label will essentially take an 80% profit share or 80% participation on that income. But before you even see your 20%, the label has to recoup their amount. So essentially, if you're only recouping on a fraction of your rate, which is 20%, that 80% you don't ever see, and it goes directly to the label. So you're recouping off a 20% nominal value as opposed to the 80%.
So that means, to your point, if you get $100,000 advance, if you're recouping off of 20, that means you got to recoup $500,000.
Yeah, essentially $500,000. Yeah.
Why?
I think I think a lot of people are anti-label, but if you look at it on the flip side, it's no different.
Yeah, explain that.
Than like the way venture capitalists work, right? Is like you're investing in you're taking risks, right? So it's the highest risk ever, because you could cut someone $100K and they can never write a record ever again, and then that's just a write-off for the label, right? So I'm not anti-label, by any means. I'm just saying that, like, I also get the perspective of the label underwriting those deals, because they're underwriting $1 million of deal flow on any given quarter, and they have to make their ROI as well.
No, for sure. I get the ROI and underwriting the risk, but why are you underwriting the risk at a 5 times multiple instead of just recouping off of the actual 100,000?
Yeah, and I think that's where the distribution model has come through, right? Where it's like, it's traditional label deals are dying, right? And now essentially people are focusing more on traditional distribution deals, where it's like a 70-30 or 65-30.
Sure.
And now now it's the artist's favorite share, so now you're recouping at a favorable share.
Sure.
So the cost of that capital is still expensive, but it's not, a lot of people call those deals predatory, like the traditional label deal.
Yeah. Well, and predatory or not, I'm still just trying to understand, why was that model happening where you have to 5x it instead of just recouping the $100,000 balance?
Because it's just, from my POV, it's just it's just the success ratio of the artist, right? Like, in order for a label to recoup, they're going through 20 artists before they even hit it out the park with one, right? So in order to sort of justify that angle, at least for the labels, they needed that sort of risk ratio to justify their wins.
Okay, because of the volume game?
It's a volume game, yeah. It's there's so many risks outside of just creating music. Someone could stop creating music tomorrow. Someone could want to rebrand. Someone could want to, not necessarily, drop a different style of music. These are all things that are outside of the control of the traditional label system.
Got you.
All right, folks. I hope you're enjoying this convo. There is a ton of value that you can extract from it. And speaking of which, if you're an artist or manager watching this and you want to get more in-depth strategies regarding your career, then my one-on-one consultations could be for you. These are fully personalized, just you and me tackling whatever you need in your career. Now, if you're not familiar with me, if you don't know, I have over 16 years of experience working with artists like Jesse Reyes and Eminem, to managers like Troy Carter and Tyler Henry, to working with brands like Nike or the Toronto Raptors. I have deep knowledge in many areas of the music business that can help you map out your next moves. Whether that's helping with your personal brand or creating a marketing plan or building out your content strategies that actually provides results, or simply navigating the music industry to whatever is most relevant to where you're at, I want to help. You can now book a one-on-one consultation session for a fee with me through my Calendly. You can find the link in the description below. Now let's get back to the pod.
Okay, there's a lot of people who watch this podcast who are trying to figure it out, right? A lot of aspiring artists or a lot of artists who are developing. Some of them are emerging, some of them are established. But let's talk about the artist who is just starting out. What is a business manager like yourself looking at to get involved with an artist who is pretty much, ground level?
Yeah, I think it's funny. I'm meeting a DJ this Friday, and he's starting to make a lot of movement in Toronto. And I just kind of asked him, just out of curiosity, at a coffee chat, I was like, "Yo, do you have a corporate structure set up?" He's like, "No, I'm trying to figure it out." And I was like, "Well, like, yo, I'll help you set up the corporate structure. There's no fee attached to it. It's just more so me sort of giving back sort of the free game that I didn't have, 10 years ago, and essentially empowering them to sort of educate them." So I think the first process for me picking up a client is like, are they willing to be educated on that process?
Right.
Because if they are, then that's a good sign. If they're getting $10,000 or $20,000 and they're willing to reinvest back into sort of their future business, that to me is a good catalyst and sign of like, okay, the artist, the songwriter, the producer has that entrepreneurial mindset.
And when you're starting from scratch, now let's say you start with them, right? I guess you can't. This is like all a la carte at the end of the day. Like you can't really say like generally.
No, I would say if I'm working with a new artist that has never worked with any business manager before, I think the first two things is like, hey, separate your personal expenses from your business expenses.
Yes.
And the way you do that is by setting up an entity or a structure that allows you to do that. And that's step number one, just like clean up, making sure that there's the right processes to separate personal and business. Now, from there, it's like, you start analyzing those businesses, you get the cash flow, you understand what's coming in, what's coming out. And it's like, well, if you're earning, let's say $300K a year from your services as an artist or as a DJ, it's like, well, what is your operating cost to live, right? Because when you're building a business, you ultimately want to retain some of those profits so you can reinvest it back to your future businesses, right? So, you sit down with an artist, say, oh, I make $300K, I have $100K of expenses, I have $200K left. And I was like, okay, well, maybe let's invest 50% or 33% back of that into the business. And the way you can do that is by then employing yourself and putting yourself on salary.
Okay.
Yeah.
Well, wouldn't you be employing yourself if you made $300,000 in revenue? Wouldn't it make sense to employ yourself from the get-go anyhow?
Yes, but there's also this like servicing costs associated with, setting up that. So, whether it's just like paying yourself, in Canada, like you pay yourself a dividend, right?
Right.
It's just setting up that process and just, most artists don't know. They'll just take what they need at any given time.
Yeah.
And if you analyze their cash flows and be like, okay, on any given month, I have, 10K of expenses. And I was like, okay, well, I think then paying yourself 10K a month right now should suffice, and then you build around that so that you create some sort of consistency in their life.
Sorry, when you say you're earning 10K in revenue and then you could pay yourself 10K from the business.
No, like I'm saying, let's say someone's earning 200K, on gross revenue, but they have 10K of monthly expenses per person. I was like, pay yourself the 10K,
Yeah.
Like you want to pay yourself.
As a dividend?
It depends, there's different tax structures, but you want to understand what your monthly cash flow needs are for a personal setting.
Yeah. Oh, on your personal side.
Correct. And then you would pay yourself the 10K, to your personal self, and then use that to pay your personal expenses.
I see what you're saying. Okay, yeah. So, but that wouldn't necessarily be meaning put yourself on a payroll. That just means
there's a lot of ways to do it. I think the North Star is that, you can put yourself on payroll, but that comes with time. Like there's other ways to do it without, registering with, a payroll office and setting up those additional costs. Like I think you phase that out.
Okay. And again, I'm gonna go high level. I'm gonna ask you these general questions here. So what is a dividend?
a dividend is a type of distribution, at least for Canadian purposes, because it's it's a very favorable structure here. It's like where you pay yourself from a Canadian corporation, but it's not necessarily a salary.
Yeah.
So essentially allows you to take out money from your company at like a predefined tax rate,
Mhm.
as opposed to paying yourself, 200K and then figuring it out at the year end with CPP and EI and all of these deductions that then you're like, oh my God, why do I have this 40, 50K tax bill? I took out, 150K, right?
Right. Right.
So
Right.
it's essentially allows you to plan ahead of the time.
And what about in the US? What is the equivalent of this?
Well, US is interesting because they have LLCs, but LLCs have like flow through structures. So whatever's left in that LLC gets taxed to you directly, right? So that's why it's good to write off a lot of
It's
expenses.
crazy.
Yeah. But there's you can set up a corporation as well, but LLC seems to be like the the golden standard for a lot of artists.
Yeah, got you. So on that note, where you're talking about like, oh my God, I got this crazy tax bill. What are some common mistakes that you see in a artist?
I think when you look at a lot of successful artists, part of the reason why they take that label deal or that secondary advance is that they have to pay off some of their taxes or they have some liabilities or they're refinancing their home and they need to put down more money for equity on a property, right? So I would say that I think a lot of common mistakes is taking that advance money, not tax planning from day one.
Mm.
And then when it comes to year end, it's like, surprise, surprise, the IRS this year wants to collect. And I think what a business manager is supposed to do is just sort of, set that expectation up front that, hey, like if you're making money, you're paying taxes. A lot of people think that's a bad problem. And also no one wants to pay taxes, but it just shows the government that you're actually making money, right?
Mhm.
So it's like a weird thing where it's like paying taxes just is a catalyst that you're making some money.
Yeah.
Right? So it's like, you just have to plan against that grain,
Totally. And I mean, if I'll take like a personal experience. Before I got into the music
Mhm.
business, I was doing sales door to door and I was making a lot of money and I was in British Columbia.
Mhm.
And I was 19 years old and I made 65,000 in 6 months. And it was a lot of money, but like I didn't realize that I was a contractor. So a lot of this, like you're self-employed
Mhm.
essentially. By the end of the year, I remember making that amount of money and I sat down with somebody and they said, you're gonna have to pay taxes of $15,000 in
Yeah.
taxes. That's all I kind of had saved up.
Yeah.
And it was like a shot to the face. And I said, I'm not paying that shit. I went through I've never talked about this
Mm.
publicly, but
Yeah.
like I went through I think I was 19. So it took me 12 years to pay down that debt.
Mhm.
I didn't pay down that debt. And it continued, the interest continued
The
to,
compound, yeah.
and we're in a way where I had to pay up to $30,000
Mhm.
Canadian. I ended up getting a loan from the bank because I started building up Mad Ruck, which is my production company. It was generating revenue. We had salaries, and then the bank started to see those statements like, okay, we could trust that we can give you this loan based off of the money that you're making. But it was like it was a huge weight on my shoulders. And like,
Yeah.
because when you owe that money, like, and you're 19 years old and I'm $15,000, and now I go, instead of paying that money, that taxes, I'm going and partying.
Mhm.
I'm having the time of my life, always going out. And then next thing you know, I got a $15,000 debt. Then it's $16,000. Then it's $17,000 because there's interest on that. Now they're freezing my assets. I mean, like literally, like my shit was getting frozen in the bank. Like,
And
that's a real thing.
and that's a real thing that most entrepreneurs face because entrepreneurs are so frontline. They're focusing on, hey, how can I increase frontline sales? Because without the entrepreneur, there's no real need to service the back office, right?
Right.
So so you guys are so focused on increasing sales, which should be the end objective.
Yeah.
I think the business manager is like that that silent partner behind the closed doors that allows you to sort of prepare and navigate the tax implications. Like, so like whether it's prepaying your taxes or opening up a new bank account and putting money aside for taxes. Like that's the whole premise of what a business manager should do. Whereas an accountant is more like year end. Like you go to your accountant at year end. It's like you give them all the information and they're planning for sort of retroactive. So they're looking back.
Yeah,
As a
exactly.
business manager is kind of in that thing where they're looking real time back, but also thinking about the future.
Yeah. It's a heavy burden if you're not setting yourself up.
Yeah.
And I talk about that from personal experience. And I say that because like there's a lot of 19-year-old kids who get a lot of money in this business, don't know what to do with it. 24 months later, ass out on their face, and then all of a sudden they got a $50,000, $100,000 debt.
Yeah.
IRS is coming after them, left, right, and center. That's a lot.
Yeah.
You know, and only not too many people can get out of that hole. So to your point, figure these tax implications, accountant, business manager, as early as you possibly can. So, I mean, would you say that it makes sense to speak to somebody out the gate once you get a windfall of money?
I would say that like at the point at which there's a movement within your career, like, you know, if you're dropping music and you're becoming an entrepreneur and you're making a couple $1,000, I think it's important at that point to understand the importance of, whether you have an accountant or whether you don't have a business manager, the importance of understanding a corporate structure that you can set up, which nowadays, you know, you can, in Canada, you can do it for $500. In the US, you can do it for under $1,000, you know, depending on which jurisdiction you're in, right? Like, it's become so accessible and self-serving that I would say from, you know, I wouldn't say from day one if you have no money, but, you know, the minute things are moving and going and you have these little small sort of proof of concepts, like, you should set up that structure.
Okay. Now, how does a business manager make sure that the artist or the producer, creator, is keeping as much money as possible from a legal sense?
Yeah, I think, you know, the business manager is supposed to like essentially audit the business, right?
Yeah.
And say, you know, some attorneys work off, you know, commissions, some attorneys work off, you know, fee for hire. Like, I try to look at repeatable processes within a client's business portfolio and say, hey, like, you know, we can save costs here, right? Like, that's a big part of it. And the second part of it is identifying money, because the reality is when you're early on and you get that one hit and you don't have that publishing deal and you don't have necessarily that label deal, there's a lot of royalties that go uncollected.
Yeah.
Right. So that's also an angle for me to be like, okay, let me look at on the publishing side, let me look at MLC, let me look at your PRO, which could be BMI, ASCAP, SOCAN. And most times people don't realize there's a lot of money that just goes uncollected.
And the black box, as they call it.
The black box, yeah. And then you have, you know, sound exchange, right? And that's part of, you know, for on the neighboring rights side, right? So most people just collect on their master if they're self-distributed because that just pays out, but they forget about publishing, which includes the, you know, the performance side and also the mechanical side and also the neighboring rights side.
So let's talk about, how do you collect those?
So there's two ways to do it, right? Like, early on, before, you know, a client is figuring out their business, you can actually manually register and claim it. And the problem is it's super tedious, right? So for some of my clients, before I even go shop a publishing deal or go to shop, you know, a neighboring rights deal, I see like, what are we collecting on? What are we not collecting on? Because when I know what we're not collecting on, it allows me to justify and size the amount of revenue that's missing. And, you know, with experience, you can now eyeball it now because, you know, if you understand that, 80% of the streams is coming from the US, okay, well then, you know, and there's radio, okay, and you can, okay, like public performance royalties are there, neighboring rights are there, et cetera, mechanicals are there as well. So, you know, I think a business manager just kind of provides that sort of high level executive summary of like what's missing and how can we amplify those revenues.
Do you mind if we go into the rights? Because,
yeah, of course.
I mean, you have a deep knowledge of this and I love this conversation and I nerd out on this type of shit, but like, I don't know, people don't really know what, you know, master rights are, publishing rights are, I don't think. And I think it's worth us talking about that a little
For sure.
Yeah. So, and how many different rights one can collect on. So let's talk about publishing, for example. Or actually, let's talk about the master recording first because that seems simple enough.
Yeah.
And then we could talk a little bit about publishing. So let's talk about the master copyright. How do you collect on this?
So
you say you're getting tens of thousands of streams. How are you collecting them?
So if you are in a traditional label deal,
you're never getting paid.
You're never getting paid. But if you do get paid, you're getting paid from the label, right? They're paying you out because they collect, they distribute, and they pay you out, right?
Yeah.
Which triggers another thing because then there's audits, which I think is a big problem in the industry, which we'll talk about. You know, so, you know, if you're going through a traditional label system, they ultimately collect, they pay you out when, you know, once you're payable, right?
What about independent?
If you're independent, you know, that's probably the royalties that most artists collect on, where, you know, you're with a TuneCore, a DistroKid, a Two Loss, you're self-distributed.
Venice Music,
right? You know, shout out to Venice Music. The value propositions up front, like either you pay like a fixed fee per release, a fixed fee per year, or they take, a small distribution fee on the back end, and it's very easy to validate those numbers because you get metadata statements, right?
Yes.
So you can really like understand how much is being taken off of on the distribution side.
Okay. And so what are some other rights in that master copyright that people can collect money from?
I would say neighboring rights, neighboring rights. So you would think that, when you collect on, and I categorize neighboring rights as part of the master, but, and people have different ways of portraying it, but kind of, it's a derivative product, or it's a product of the master recording. Sound exchange, right? So the first point is like, oh, are your songs even registered on Sound Exchange?
What's Sound Exchange?
Sound Exchange, when you get some songs played on Sirius XM or Pandora, those performances, are not collected through traditional channels on your distributor. You have to go through, Sound Exchange or neighboring rights collections to actually collect those revenues.
For satellite radio, what about terrestrial radio?
Different regions have different rules, so it gets very complicated. But in the US, which is majority of our clients are based out of, I would say that, traditional radio, you have public performance, and then you have mechanicals, which is, derivative of a stream, which can be performed publicly, which can be performed, in a restaurant, etc. So there's a lot of layers in this, and there's a lot of fraud that happens within royalty collections to begin with, but at a super high level. Yeah, because people don't get their blanket licenses, because technically if you have a bar and you're playing music, you should get a blanket license. But not everyone is.
From the PRO, from ASCAP or BMI in the US or SOCAN in Canada.
Yeah, so people aren't issuing those blankets. So it's very unpractical to try to solve that whole problem. But so you try to target the big issue, which is like, if my song is getting streamed on satellite radio, I'm collecting that.
Yeah.
That's a lot of money.
Yeah. And that's now, again, so when it comes to satellite, Sound Exchange, collecting on the master copyright. So so they know what a master composition is, basically whatever you're recording in the studio and that is being heard. Correct. That's the master.
Correct.
Right.
It's the final product. It's what you hear on when you're playing it, right? So I would say like on the master side, it's really like, are you collecting, like at least from my point when I'm working with a new artist, are you collecting on your master side, or are you collecting on your neighboring rights? And then once I kind of investigate and see, okay, because sometimes you might have 20 songs distributed with one distributor, but either that one song with that one label, so that one label pays you, but they only pay you every quarter or semi-annually. Like you have to investigate that, because an artist won't necessarily know where to start and where to go. Right.
And so neighboring rights, Sound Exchange, you said, what are some of the?
Yeah, so they have, there's a lot of neighboring rights offices globally, I think it's like 20 plus.
Yeah.
But that's why when you get to a point where you understand what's being collected, what's not being collected, to look at an administrator to sort of collect your neighboring rights.
Right.
Like a peer, for example.
Yeah. And so now when we're talking about terrestrial radio, those copyrights, or not copyright, those rights within the copyright aren't from the master side, correct? They're from the publishing and the songwriting side, correct?
So it's interesting because there's two sides to every coin, right? Like even like when you stream a song, right? And streaming can be considered a form of radio depending on how it's being consumed, right?
Yeah.
So Spotify doesn't collect everything. There's also some stuff that you can collect directly from Spotify, directly on the mechanical side, right?
And the mechanical side is on the publishing side.
On the publishing
side. The songwriting side.
Correct.
Yeah.
So there's like a ballpark theory that, for every $1, 10 cents is paid out to mechanicals. By no means is that like an industry standard, but it's like just kind of like an unhidden rule that there's, whenever you have $1, 90% gets paid out, 10% is actually for mechanical.
On the streaming side?
On the streaming side, yeah.
Yeah, which is why a lot of the publishers are always constantly pushing back with the DSPs, the Spotifys, and the apps to raise the rate.
To raise the rate so that songwriters can essentially, get paid more from that, right?
Yeah. Yeah, and this is one of the case and the arguments that songwriters and publishers make, which I think is a real one. Is just like, hey, without the songwriting, there is no fucking master composition.
Yeah, and it actually triggers. There's been a lot of lobbying for sort of songwriter rights, right? Like also making sure that they get paid the right amount, right?
Yeah.
So when you look at that and you think that okay, there's advocacy for songwriters, and hopefully maybe that rate goes up in the future. A lot of these catalog buyers are also looking at sort of the mechanical rates. And if they assume that, that rate is going to go up, it's also just going to increase their investment too.
Mm.
From that POV, when you look at it like a macro level.
I never thought about that.
Yeah.
That's interesting.
Because they're investing in sort of the publishing side of it,
Yeah.
depending on what.
So now on the publishing and the songwriting side, so to be clear, this is the part where, you're in the studio, you're at home and you're writing the song and you're recording it, you're producing it, all that. That's a publishing and the songwriting side. So that's a copyright in itself. But there's a bunch of rights within that copyright.
Yeah.
Mechanical, performance,
and sync.
sync.
Yeah, sync.
Right,
Yeah.
and synchronization. And sync is?
So synchronization is like for anything audio visual. So think of like a TV commercial, anything that sort of pairs music with a visual, content.
Yeah.
But now it's even, there's microsync now. Because like now you have microsync is like, that's Snapchat advertisement music, right? It's kind of like these small, syncable moments that like it's becoming a big issue to even collecting on microsyncs now.
Amazing. Okay, I think that's really dope. I think there's a lot of good clarity in all that.
But to summarize, is like on the my first course of action when I work with a new artist is like check their master, check their neighboring rights, audit what hasn't been collected on.
Yeah.
And then that's my starting point. And then similarly, when I start with, on the publishing side, I scope out, are they registered with the PRO? BMI?
And a PRO is a
performance rights organization.
Yeah. So like a BMI, ASCAP,
SOCAN.
in Canada, SOCAN.
Yeah. But it's interesting, even that it gets more complicated because different regions collect different rev shares of different styles of revenue.
Yes.
So that's why I kind of focus on the US Canadian market because it gets even more complicated overseas.
Do you have partners overseas to collect that?
Yeah, and I think that's where you look at working with an administrator and a true administrator that has sort of boots on the ground support to actually collect, from local radio, et cetera.
Yeah, an administrator being a publishing company like a
Cobalt.
Yes.
A Warner Chappell.
Gotcha.
Now there's a lot of sort of boutique distributors as well that sort of white label, a Warner Chappell's back end, and then they also serve as a publisher. So there's a lot of moving parts to it too.
So you talked about audits.
Yeah.
When do you actually approach a royalty audit?
I think,
and how?
this whole audit thing, I think it has such a bad stigmatization because if you're a Fortune 500 company, you get audited every year. It's a requirement, right? So why not have that same sort of positioning with your money to like audit the people paying you out, right? So I think it's healthy to gut check it, but I would say a good starting point is if you're earning money from your catalog, for example, or if you're unrecouped and you're trying to see what expenses are being deducted, because oftentimes a lot of expenses can get deducted without your full oversight.
Mm-hmm.
You want to make sure what's being deducted, and you want to make sure that your revenue is being collected at the right rate. So I think it's important to audit either one when you feel the need that you're like, hey, like I feel like the label is deducting expenses, I don't have full transparency on it, or you're recouped and you say, hey, I want to see what they're collecting on and making sure that they're paying me my fair share of what I'm owed.
And how do you trigger that?
When you look at a recoupment balance, right, you kind of have this mental gauge. It's like, okay, if a client is recouping as 100K and they're recouping 25K a year, and the catalog is moving, so there's no decay on the catalog. And then you see that, like next year they recoup 18K or 17K. It kind of triggers like a mental sort of exercise. And I think
like what's going on here?
But on the flip side, audits are expensive. They start from anywhere from the lowest end, like 15K all the way up to like $50,000, depending on how big your catalog is, right?
Okay.
So it's an expensive initiative, and labels and distributors have very sort of strict auditing timeline and guidelines. So it makes it very hard to audit in a specific period because some labels only go back, 24 months, 3 years, et cetera. And you have to literally then hire a third-party CPA.
Yeah.
And then that third-party CPA has to engage the label or the distributor. So it's like they make it very difficult to audit the label system.
Why?
I think because when you make things a difficult process and it's an expensive process, people are potentially inclined to not invest in that.
Yeah.
But if you're in a position where you set up your business correctly and you're recouped, you're making money from touring, you're making money from merch, you're making money from your music, it's like it's you would want to invest into that process because it's just a gut check,
Absolutely. And so when you're saying that, so those would be the artists and the business manager who are hiring a third-party CPA
Typically, yeah, that's included like the third party independent CPA. So it can't even be. Oftentimes, it can't even be myself.
Oftentimes.
Yeah.
When can it be you who is going in and doing the audit?
I mean, I feel like with certain distributors you can negotiate it, but a lot of
But like a major?
yeah, they won't budge on a lot of the auditing.
You said they have some strict guidelines.
Mhm.
What can you talk about with some of those
Like
guidelines?
for example, you can only backdate 2 years of revenue, right? So
Right. But the CPA can get past that 2 years?
no, it's typically just the 2 years. Like it's stated within the contract, like an auditing clause. 3 years. Sometimes you can go back up to 3 years, and then not only that, you have a very short window where, like, traditionally you would have your CPA fly into the label
Yeah.
and actually have like a short window of 8 a.m. to 5 p.m. to actually conduct the audit. So they make it very, very painful to conduct and gruesome and sort of bureaucratic to even open up the books.
Okay, so say if I'm it's good to know.
Mhm.
But now let's say, okay, I'm an artist.
Mhm.
Something doesn't look right. I go and I talk to you. I say, hey, we need to go and audit.
Mhm.
We're generating real revenue, but something doesn't seem right.
Mhm.
Dan, I want to go and audit. Who are you talking to first over there? Is the manager also getting involved in the audit, like the artist manager as
Mhm.
well? Are they talking to somebody? Is it?
I think it's something that's initiated for sure by the business manager because it's a very, very technical process, right? So, unless the artist manager has done audits before, it won't be like a first stop for them. So the first step would probably be like, hey guys, from my POV, I'm looking at your statements, XYZ. I think we're in a healthy place to conduct, an audit. Explain to them the rationale behind it, right? And there's been very, 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 there's a lot of case studies of audits being successful and people collecting a lot of money.
Yeah.
Right? So there's, the justification of it. Because at the end of the day, we live in a world where there's a lot of manual process. Like, you don't know if that accountant at UMG or that accountant at Warner made a manual mistake, like not a malicious mistake.
Right, exactly. It happens all the yeah.
Right? It happens in any accounting and finance function, right?
Mhm.
Which is why like the word audit even arrived, because you have these mastermind CFOs at these large Fortune 100 companies, and even they get audited as a yearly.
Mhm.
In the music, it's sometimes artists don't even audit any time of their catalog, right? So that's where I come in, right? So my proof point would be like, let's analyze the revenues, let's see where we're at with respect to that, and if we're in the money in our catalog, let's conduct an audit. And I explain to them that process, and then I would hire or engage a third party auditor, typically like a CPA that specializes in this business, and then the auditor would say, hey, by the way, I'm issuing my audit notice, CCing the auditor on hand, and then you kind of do the request files of just going down. Okay, send me all the revenues, send me all the expenses. Let's validate these.
Who are you talking to at the label to initiate that?
Oh, so typically there's a contact. On a label contract, there's a contact form, right? For audits, or there's an attorney that represented the counterparty. So you typically issue it to the other legal side.
Got you.
Or-
So
or,
it's
yeah.
like BA or legal on it.
Yeah, BA and legal affairs. Yeah.
You know a lot about this world, man.
Mhm.
What brought you so much interest in this world here?
I think I understood that I had a very good technical understanding even prior to music.
Uh-huh.
Like, I got into this business by writing grants in the Canadian grant system.
Yeah.
And I realized that a lot of artists who had, 1,000 followers, 2,000 followers would get grants because they understood how to write a business plan. And then you would have artists who had 50K, 100K followers local in the city that would not get any grants. And I was like, what's the rationale? Because the Canadian funding bodies would disclose all the grant winners, right? So I started to look into it.
Oh, okay.
And I was like, yo, why is XYZ getting a grant, but the person that I know who's doing the numbers and streaming getting the grants? And I realized that just understanding process. So understanding process is just like what allowed me to just keep on searching, and just doing a deep dive on the process of how royalties are collected, the process of doing a producer agreement, the process of a label deal. And I just kind of became very, very hyper-focused on understanding the process of each sort of business dealing.
Do you think it's overly complicated?
100%. I think that even attorneys, who are underwriting these deals don't understand the mechanical rate or don't necessarily understand, how metadata is being reported by each distributor, because each distributor has its own unique way of doing things.
Have you come across attorneys where you realize that they don't know what they're underwriting?
I've come across deals where attorneys write these ridiculous clauses of like, when you recoup your publishing advance, it's based off 2/3 of the mechanical revenue that you've earned from XYZ. And it's like literally an investment banker's nightmare to calculate those numbers, right?
Yeah.
So yeah, I think, the attorneys themselves don't even know how to calculate those numbers as well.
Is there a way to simplify this from your perspective?
I think by just, when you're negotiating deals for your clients, to just be very, black and white. I don't like operating in the gray, so I kind of, that's my mindset when it comes to working with these deals.
What do you mean when you don't like working in the gray? Can you
I don't like, for example, if a client is going to an option 1 or an option 2 of their publishing or their master agreement, it's like, I want to make sure there's a very clear path forward to go to the second option.
Yes.
Right? I don't want it to be like this thing where there's a lot of ambiguity of how to exercise that second option, and then the label's not having a defined time frame to get back to you, right? Because if I'm exercising an option and my artist is moving, I don't want to wait 3 months for the option to kick in when things are moving around.
Yeah, real shit.
I want to make sure that, okay, I'm going to give you guys, hey, by the way, I delivered this project. What does the path forward look like for option 2? And if you don't respond, by 90 days, it's like, then I'm going to take it, as you don't want to renew the option. So like having those things up front are super important
In the paperwork of the agreement,
yeah.
the contract.
Yeah, because that's where everything that's where the magic is made, right?
What are some other things that people should be looking out for when they're actually doing a deal with a major to make sure that they're not getting stuck in a situation where they can't put out another song or another project if something is going crazy?
Well,
And when I say something going crazy, let me be more specific. If you have a song that is actually streaming real revenue consistently, really growing, but now you can't put out a second song.
Yeah. Well, I think also too, like there's this clause, which is pretty standard in most label deals, where it's like, there has to be commercial satisfaction. It's commercial satisfaction.
Yeah.
That's enough, which essentially means that, it needs to be approved by the label, right? If you're moving, the label wouldn't want to reasonably withhold your momentum. However, if you are, let's say, going from option 4 to option 5 and you're going to your last album deal, there's kind of like this influence to deter the label from making you release that sort of last single or that last project, because it comes to the point where like you're out of your deal, right? So, I think it's a very dynamic thing, but a very common thing, for example, is like singles versus projects, right? We live in a singles-based era.
Yes.
So, an artist can release, 10 singles, right? And that won't even count towards one project. So they over-deliver music.
What do you mean?
So let's say, you have an option, you have a traditional label deal. They say, okay, they want 5 albums, right? 5 albums, let's say, comprises a minimum of 12 recordings or 10 recordings. You deliver those 10 recordings as singles, and it's not packaged as an album, they won't count as commercially satisfaction for that album, right?
Yeah.
So you want to do things like, okay, I can deliver, a project, but 5 of them can be singles.
Yeah. Or all 10 could be singles, but it's going to constitute as one album. 10 singles is the equivalent of one album.
Correct. Because you get into a position where a lot of artists actually over-deliver on their contract. And it's the one place where it's like, the artist wants to feel the need to release music. They're putting up the bread, or they're using that existing marketing advance or A&R advance to create that music, but they're not actually getting the benefits of the upside on the delivery when they deliver it.
No, it's a good point. Do you recommend that artists over deliver on, songs, even though it doesn't go towards the contract, but because you want to satisfy the general public as well?
I think you want to support what the artist wants to do, right? And just explain to them that, hey, like it won't count as a delivery, but we live in such a short-term based attention span economy that you have to consistently feed the streets with music, right?
Yeah.
So you can't, I'll never deter an artist from not doing something that they truly want to do, but also explain to them the implications. Like, hey, like if you deliver those 30 additional singles and you're still on option 2, you still got option 3, 4, and 5, like honest truth,
So how do you protect IP from the artist and prevent, rights getting lost in bad agreements, bad contracts, I should say?
Yeah, well, there's two forms, right? The first form is that you pick up a client and you're with them from before the process, or a client, fires their whole team. They're looking for new business management support, and you inherit a new contract, right? So when you inherit a new contract, it's a very different approach from when you pick up a client from ground zero. Because from ground zero, you can just kind of train and educate them on all the implications and play scenario analysis. But when it comes to inheriting a contract, you have to live within those contractual means and find a cohesive strategy to do that. And sometimes you can negotiate an existing contract as well. It's not completely out of the norm, but it's just a harder process.
And so how do you go about that under negotiating an existing contract? Can you provide an example? You don't have to say names, but like an example of something that you've done before, or
no, I think there's examples where a lot of boutique labels, for example, want to invest in an artist, but the artist is growing faster than the boutique label, and they don't have necessarily the cash resources to fuel the fire. So, what you could potentially do is like, hey, like, I'm on my third option. Why don't you release me, take an override on the next deal, and, also still get that unit economics on the music to make sure that we sort of fit the contractual terms, and also recoup any balance that you have for any existing music released with the current, label. So,
okay. I have average intelligence at best. Let's break that down a little bit. Okay.
Yeah.
So when you're saying override on a deal,
yeah,
what does that mean?
So for example, let's say if I sign you, you become bigger than me, and I'm a boutique label,
Yes.
like I don't have the crazy staff, that, a UMG has, right?
Yeah.
I signed you for, let's say, $100K.
Yeah.
We get to a point where, you need $1 million budgets.
Yes.
But I'm not in a position to provide those $1 million budgets.
Yes.
Right. So what happens is that, you come up to me and be like, yo, like, I want to find a more strategic partner. I know I have, projects that are pending delivery. How can we work this out? And then, we come to the point where it's like, hey, you know what? I'll release you from your contract, but in exchange for me releasing you on your contract, on the next project that you release, whether you go independent or whether you go with another label, I also participate at a smaller rate.
Yes.
Going forward. But for anything we worked on before that sort of new negotiation happened, if it's unrecouped, it stays there until it becomes recouped.
And then if there's, you can get still generate revenue off of that if you've licensed it for X amount of years.
Correct.
Or if you own it outright, or have in perpetuity.
Even if you license something for 5 years or 10 years, if you still remain unrecouped, you're unrecouped even beyond that licensing period, traditionally,
Yeah, of course.
So, I think it's a way for you to pivot the situation. It's not ideal, but there is some room for negotiation. Everything's negotiable.
A lot of people kind of look down on the advance, right? So, and I don't think that's necessarily accurate. I feel like everybody's situation is very different. And I think you just have to kind of look at it in terms of like, okay, well, where are you financially? Can you use that to get out of a bad situation that you're currently in? And then can you actually create a good process and a system for you to be able to build a real business? Because at the end of the day, an artist is a business. So you're building a brand, right? And so you want to make sure that you're making the right decisions in order to grow that business. So an advance can make sense. You know what I mean? For certain aspects. But I guess the question is like, when would you recommend an artist go for an advance versus doing something self-funded? Yeah,
and just to add to your point too, is like, there's a lot of successful artists, when you think of like the Drakes of the world, who, went through, UMG and then Young Money and Cash Money, and there was a lot of layers to those deals, right?
Yeah.
But Drake is still a global icon, right? So my thesis is that, or my belief is that, if you're consistently growing and your streams are growing and your trajectory is growing, there's no inherent need for the label to withhold money from you. The issue becomes when you go for a project and you don't recoup on that project and you're plateauing, or your fan base is decreasing. That's when the labels don't feel the need to reinvest or re-up in your project. And I think that's the big disconnect. I think that the capital that you earn, whether it's a label, whether it's independent, if you're making great music and your fan base is growing, I don't think it necessarily matters who's providing the capital. One's more cost effective for sure, because if you go seek independent capital outside of the label ecosystem, you might get better financing. But, I think when you look at the greats, they've all met their contractual needs, have went independent or renegotiated their contract, and now they're in their Supermax era.
Yeah.
So like, it's like, it on one side is like, yeah, it can trap you there because if you don't recoup. But if you make it through the hurdle of delivering 5 projects and being in the money,
Yeah.
like you have successfully, you're like the 1% of the world.
And you have to ask yourself, if you are incredibly successful and your business is growing, why would you stay at a label, right? It makes sense because ultimately the label's going to do a more favorable deal.
Mhm.
Drake is one of them, but the best case scenario we could talk about is Taylor Swift.
Yeah.
Taylor Swift, for example, she renegotiated her deal because clearly there's real revenue that's coming. There's a growing business.
Yeah.
It's attracted a ton of investment, a ton of visibility. Universal Music is a public company, so it's
Mhm.
great for the public, for the shareholders. So they're going to renegotiate a deal in her favor,
Mhm.
right?
No, 1,000%. And I think now we've come to the point because a label can no longer by itself break a hit. Like before 20, 30 years ago, you could push a button and get, radio,
Yeah.
like we live in such a different time now,
Yes.
right? Where it's like, the contractors that, the same marketing agency you can contract independently outside of the UMG ecosystem because they just subcontract a lot of their marketing, right? So if you can
Exactly.
find a way to source your own capital and monitor your P&L, I think this is where a business manager actually amplifies a business when a client maintains an independent business.
Again, average intelligence at best. Let's go back for a second.
Yeah.
What's a P&L?
P&L is profit and loss, right?
Okay.
So, if I were to do a traditional label deal, they'll give you $1 million deal,
Yeah.
$500K is paid to you in your pocket, $250K, upon delivery, and let's say another $250K marketing budget. So the all-in budget is $1 million, right?
Mm-hmm.
And let's say the distribution rate is, let's say you're doing a JV, 50-50, right? The onus is that the budget is controlled by the label, right?
Mm-hmm.
But if you could go get your own external financing and have your own business manager or someone on your team control that budget, you can actually achieve the same thing, if not more efficiencies,
Okay.
right? So, I think that when you become independent, the need for the business manager actually just increases a lot more because now the money's in your account and you need to figure it out.
Yes.
Yeah.
And that's where the profits and loss statements come in. So essentially meaning
Yeah.
like how much revenue you're generating,
Yeah,
then spending.
exactly.
Yeah.
Yeah. And then also too, like, people just think of music as like the advanced game. Like, no, the real business is creating a company,
Yes.
building IP. That IP becomes valued at something at a crazy multiple, right? You look back 2-3 years ago, people were paying 18x for records, right?
Yeah.
Because that was what the market deemed, right? Like it is an asset class, right?
Yes.
So you're building IP within your company, and then you use that as a launching pad to build more businesses. And I think that's where the business manager is essentially shifting the role from becoming like someone that's just paying bills, taxes, and bookkeeping to a strategic operator, to a CFO, to COO.
So let's talk about that a little bit because the conversation of multiples and selling catalog, the Bieber catalog has come up a lot as of late. What does that business all look like? What does that mean for people at home who kind of have an understanding and like to hear these like a multiple of like 14 or 15? What is that based on? What does that all mean? Break that down.
So a multiple just means whatever that artist is grossing in terms of revenue, whatever the artist share is, a multiple is just being like, hey, we'll pay you an advance on that multiple, but it's not a traditional label advance. They actually just own the copyright.
Right.
So they'll advance you money or they'll pay for that sort of 10 years of what that you can exploit that copyright for upfront in exchange for owning those rights.
So the example would be your catalog, your music that you put out there is generating $1 million a year. Somebody who has the capital will say, we will buy your catalog outright, 100%, and we'll pay 10 times what that's worth. So we'll give you $10 million to own the copyright outright 100%.
Correct. And the idea is, and this is, music is an alternative asset class. So what does that mean?
Yes.
So it means that
average intelligence.
It means that, when you look at the public markets, the S&P 500, right?
Yeah.
You invest in the biggest companies in the world, Google, Facebook, that market is correlated. So when the market does well, like the S&P will go up. When the market does bad, the S&P goes down. Music is uncorrelated. So it's like whether it's up or down, people are still consuming music.
Correct.
So that's why these hedge funds, these capital allocators, people cutting checks have become so intrigued by that. And then when you double click on, the alternative asset class, which essentially just means like private equity, venture capital, gold, just these alternative investment strategies that aren't necessarily correlated or aligned with the S&P, you realize that music is a very liquid asset and it's an alternative asset, meaning that investors who are looking to diversify their portfolio can now allocate some of that bit or portion of it to music catalog and earn a return.
Mm-hmm. Mm-hmm.
And what's interesting about alternatives is that alternative investments, private equity, venture capital, have historically been very illiquid. So illiquid means that you can't, when you invest in the early stage of Facebook, when you invest in these early stage tech companies, you can't cash out your position until there's a liquidity event.
Yeah, you can't take the money out. Money's stuck.
But music is an alternative asset class that is super liquid. You can take someone's Schedule A, literally send it to an asset buyer, and within 15 days, you can have that cash in your account. It's literally become easier to sell your catalog than this is like sell my house. My house will be listed on the market longer than selling a catalog that's actually moving.
Really?
Yeah.
Wow.
So like that's how easy catalog has become to sell.
Yeah. And that's why there's so many people coming into it now looking.
And then now people are bidding up the price, right?
Mm-hmm.
So, that's why, I think music has become that institutional asset class that's just favorable for a lot of people, because not only do you get an investment that's uncorrelated to the traditional marketplace, you get exposure to a new type of investment, but it's also liquid.
Yeah.
You can sell it within 15 days.
So how do you make an artist's catalog an attractive investment to these buyers?
So you look at something called decay. So decay is like, historical earnings.
Yeah.
So if a client was earning $10 last year on the catalog and earned $3 this year in the catalog, you call it decay. It's like the rate at which the catalog earnings decline,
Mhm.
right? The lower the decay, the lower the decline of historical catalog, the stronger multiple you can get, because it's a predictable asset class. 20 years from now, 30 years from now, I'll still be playing Thriller, you'll still be playing Thriller, our children will listen to Thriller, right? But music has become so accessible that a song can literally hit for 6 months and after that decay by 50, 60, 70%.
Mm-hmm.
So you're looking for catalog that has quality, that has low decay.
Got you. And is that how you negotiate multiples? So how do those multiples get determined?
Correct. Yeah. It's the primary factor is historical earnings. So if you have a low decay rate, if your catalog's earning 1,000,000, 900, 1.1, 1, 800, 900, 1, that's very low decay because there's a lot of consistency across that catalog,
Yeah.
right? So to an asset buyer, it's like, if a catalog has very low decay and you typically look at it from 3 years, 5 years, etc., you can predict that in the future, the catalog won't decay as much. And in addition, the catalog buyer will also service that catalog in order to invest more in it so that they can actually increase the value of that catalog.
What does that mean?
So servicing would be like, I buy your catalog, but I'm not just a passive investor sitting on your catalog. I'm actually investing in marketing so I can increase the value of that catalog.
Mm-hmm.
I can get it streamed. I can get it synced, etc.
Mm-hmm.
And I think when you look at big catalog buyers, you have passive investors that are just looking for the reoccurring coupon or dividend from streams, or you have active catalog buyers that are actually looking to exploit that song in a more cohesive way, get better distribution rates, and essentially try to place those songs in sync, etc.
So what are the conversations you're having with an artist to make that more attractive investment?
Well, I would say one is that's why it's so important to own your masters,
Yes.
right? So it's like there's a trade-off. It's like, hey, you can take this advance right now, right? And a lot of business managers are actually incentivized to take the advance because they earn a commission off of it, right?
Yeah, that's one thing we should talk about as well, is that a lot of business managers take a 5% gross off of whatever the artist is making.
And that has changed so much because there's companies, there's business managers that do fixed fee now. There's business managers that do a combination of hybrid. There's, business managers who are more CFO fractional. So the whole 5% number is a nominal number. Like the marketplace, like what I would charge someone that just has one source of revenue versus someone that has 10 sources of revenue that I have to independently collect and manage, the economics look so different for that deal, It doesn't make sense to, for most business managers to take 5% of a client that's earning nothing,
Mm-hmm.
right? So you might charge, monthly retainer, right?
Mm-hmm.
But for, a client that I'm providing CFO services, we're managing their payroll, we're doing their taxes, we're providing thought leadership, we're helping them validate their catalog, we're we're helping them negotiate their merch, we're securing financing from different parties. Like that is a very different relationship in excess of the 5%.
Yeah.
Right. So it's interesting. Like the business management world is going through such a big transformation. It's almost like the business manager is now managing the family office of these independent creatives.
We should talk about family offices, but I'll go to that in a second because I want you to continue talking down the path of how do you make that investment attractive. So you're making sure that the artist is owning their masters is one.
Yeah, owning their masters or have some form, because you can own the masters.
Some form of participation. Yeah.
You can own the masters, or you can have like a profit participation, right?
Yes.
So make sure there's a claim to some form of money, right?
Yeah.
Or some form of cash flow.
Yeah.
Right. So if you can secure that, whether that's owning your masters or you have a profit share, which guarantees you, in perpetuity, whatever the case is, right? Now,
profit share, just so we're clear, is somebody else comes in, they want to invest in your catalog, but they say, we're going to own 50% of the master, you're going to own the other 50% of the master, and it's going to be in perpetuity. Or you could do a licensing deal where it's 15, 20 years or whatever.
Correct. Or you can do away too. Like when you do like a producer deal, when a record gets cleared, right, with a producer, right, you're putting on record.
True.
They have a share of the master, but it's typically like structured as a profit share in perpetuity. You know what I mean?
Right.
But then the artist controls the master, right? Because the artist wants to be able to exploit it, wants to put it on sync, et cetera, right? So, you just want to have a claim to a cash flow or claim to some form of ownership. So I would say prioritize that.
Yep.
I think taking money makes sense when you have a rationale to use that money, right? And, the goal is to ideally build your catalog, right? It takes a longer while to build your publishing, but your master, you can build it a lot quicker because you get paid out more on it if you own it. But the goal is just to between now and towards your next 10 years of career, how much catalog or how much ownership or how much profit participation can we actually keep? Because in the future, you can actually liquidate that.
So let's talk about that. That's a great segue for the next question that I have. So say you build up this incredible catalog and you liquidate that. So you make the sale and the transaction, right? What does an artist do after that? They make a lump sum of money, say they sell something for $100 million or whatever it may be. What do you recommend?
I think you need to know your artist's why, right? Like, what is your North Star? What do you want to do next, your next chapter, right? When I was, my client was with Jason Derulo in LA, a couple months ago. And Jason Derulo is notorious for the car washes, right?
Yes.
And the boring businesses, right?
Yeah.
And there's a lot of claims that he's making a lot more money from his car washes than it's from his IP catalog, right?
Right.
That's what, I haven't confirmed it, but that's what the industry says, right?
That's what he says.
That's what he says, right?
Yeah.
So I think understanding what do they want to do the next chapter, right? Like, do they want to invest that money? Do I connect them with the right wealth manager, right? To be like, hey, listen, you have $10 million. Like, what does your next 20 years look like or 30 years look like? Let's plan for that. And that can be a combination of investing in public markets, investing in venture capital, investing in private equity. Like, look at what a lot of, what was it, Nas that did this Coinbase?
Yeah, I think so.
Nas did Coinbase. It's like, those are the type of moments you want to create for your artist.
Amazing.
And connect those dots for them.
And yeah, so it's not like one size fits all in this situation.
No, 1,000%. Every, some people, they overindulged in their career with buying 5 or 6 houses. Maybe they need to liquidate one.
Right.
Or maybe they have a tax lien because, a previous manager or previous business manager didn't account for that. So, oftentimes catalog sales can be used to clean up businesses as well, or clean up taxes, catch an artist up to speed from like a compliance standpoint too.
Right. Now you talked about wealth managers, family offices. Let's talk about what that is and when should those people get involved?
Yeah, I think once your career matures, like I would say in the early stage of your career, you're trading your time for money, right?
Yes.
You're showing, you're performing, etc. Towards the mid-tier of your career, you've identified your brand. So now you're getting sponsorship. You're getting ancillary forms of revenue that can just be done from leveraging your name and likeness. Still requires you to trade time for your money, but you're in a better place you were, in your early stage career. When you're towards your late stages of career and your peak, you've collected all the money, you've traded all your time money, you've accumulated this wealth. you want to deploy that capital in a way that sort of services your long-term needs and goals. And I think that's when you start looking at sort of the family office model.
So what's a family office?
A family office is essentially an entity, started by the family, or, they work with someone else to sort of service their wealth long-term that goes beyond, the traditional means of how they made their music. So, it's, if they have a interest for venture capital, okay, you can hire, you can create a family office to focus on venture capital. You can hire a family office to focus on private equity investments. It just provides you a very, very intellectual structure of how to sort of deploy your money.
I think it's interesting that we talk about that because really for the first time in the public eye, it seems like you got introduced to what Bieber just did, right? They started talking about creating a family office,
Yeah.
him and Haley. So it's interesting that it's now starting to be a part of the lexicon
Yeah.
in the general public, or at least for those in the industry. But these have been around for
I mean,
forever.
it's like all the tech guys have their family office set up.
Yeah.
Anyone that's a billionaire or ultra high net worth, typically sets up a family office. But my sort of predictability is that, like, because music and the creative economy has become so decentralized, we're going to see the emergence of sort of the creator family office.
How do you see tech shaping the music business in the next 5 years, especially when it comes from the business management side?
I think technology is, and specifically AI, is going to disrupt the music industry at a very, very high level. And I'm not talking about AI to replace sound recordings and music. I'm talking about AI infrastructure, automating contracts, automating workflows, CRM. Essentially, a producer agreement will cost you $500, $1,000 if you use a good attorney. These are a lot of repetitive processes. AI, from my POV, will essentially democratize access to legal and contracts. And that's part of the reason why, I started my project Block, right? Which is essentially an AI-driven compliance software to develop contracts, to negotiate on platform, et cetera, to essentially democratize access to the negotiating workflow for creators across the board who choose to be independent.
Crazy. No, I think that's actually smart because there's so much like legality and it could get costly.
Yeah. Even like a big issue too is like when you change management or you change legal, it's like the files are kind of stuck everywhere. And like now you have to like cold call and the attorney is no longer your client. So they take longer to reply, or the manager went incognito. And it's like, there's a big need for sort of CRM and workflow management. I think AI will disrupt that market completely.
You became the GM and CFO at 27 at Neon 16, which was co-founded by our good friend Lex Barrero, who's been on this podcast a couple of times, who's made this podcast go viral because infamously he's the guy who said management should get 50%. But that was just like a soundbite. We got into like what the specifics of what that really meant, and I'm sure you were part of some of those conversations.
Yeah.
I want to know what your thoughts were on that conversation, and then, but secondly, and really more importantly, like, what do you think prepared you to become the CFO and GM at that company, which is so large, which is, it's got Tiny in there as a co-founder, incredible producer, main producer for Bad Bunny, and then you had so many other writers, and you had entertainment, which is like a vehicle for film, where you had La Firma, who Erica sitting over here infamously talks to me about La Firma all the time. It's her favorite show. So like, there's so many different things that you were doing there. At 27, like, how did you get there? But first, let's talk about the 50-50 thing.
Yeah, no. So my philosophy is that, as a manager, right? If you're managing someone's career and you're building it up cohesively, music is, I always use technology as a VC, and technology as a perfect example, right? In VC, when you put in your sweat equity, whether you're an employee or founder, you earn equity in the business, right?
And sorry, just so people know, VC means venture capital.
Venture capital, right?
Yeah.
So, like, for example, you look at all the biggest global tech titans of the world, right?
Yeah.
Like Jeff Bezos, Zuckerberg,
Musk.
They all own less than 20% of the company.
Right.
They've been diluted so significantly, but they've created so much value on the flip side of it too. They're traditionally, for the manager and artist relationship, the manager has historically not earned equity.
Right.
In sort of the ventures that they build out. So I do think it's a very feasible question to ask, is like, there should be a vehicle to sort of earn and develop equity with partners, or you create in any business, not just music,
Totally.
like, and outside of business, outside of music as well. If you're developing a car wash, right? Like you want to, build with people that, you can earn equity in it. So I don't think it's you look at managers and towards the tail end of their career, they no longer want to be managers because it's a work for hire position,
Correct.
right? After they, it's a cash flowing business,
Yeah.
but after they finish that work for hire, there's like, no, I want to build a venture with the right strategic partners. And I think that philosophy, if you have that cohesive alignment with your artist or with your producer, there's plenty of artists that build JVs with on the publishing side,
Yeah.
on the label side, right? So I think the ability to earn equity should be talked about more.
Absolutely.
Yeah.
I think the music business, funny enough and interestingly enough, is like the one business where it's predatory if you're actually a partner
Yeah.
within the catalog or the master, where every other business you are considered a founding partner, but in the music business,
It's the only
predatory.
is only business in the world where, like, even when you're in a startup, right?
Yeah, 'cause that's what it is.
When you're a first 20 employee, not even the founding team.
Yeah.
The 10th, 15th, 18th employee
Have equity.
have equity in the company.
Yeah.
So my philosophy is that if you're building a company
Yeah.
cohesively and you're aligned with your artist and your partner, and you make sure all the conflicts are checked off, because it is a conflict, right? That's the real issue, right? When you're
Yes.
managing them and also creating a business with them.
Yeah.
If you do the right conflict checks, if you're transparent, and you guys both have your own independent legal advice,
Mhm.
I think it's a beautiful thing to build a business with
Big
someone.
point. But yes, it's a real point. Yeah, no, I totally agree. I
Mhm.
mean, like, I listen, right now I own 100% of Eight of Fame participation, but I've had the conversations with Erica. I'm like, listen, I want you to participate in equity. This is why, you and I got into business, because I wanted to make sure that I had somebody in here to have that strategic conversation with people who are rolling with me from day one, right? And even like day 365, I'm growing the business. I want to make sure that these people are incentivized to stay here, to continue to grow the business and look at it the same way that I do and participate in equity, in the event that if I ever wanted to do a sale, or is there's a part of the business that we want to sell, like a subdivision of that, we all get to eat.
Correct. And that's the whole premise of corporate structure, because, you might, you're building a podcast business and you're like, yo, the people who were closest to me building the podcast business, I want to provide, a path forward for liquidation for you,
Yeah.
And then you
100%.
open up, your music management business, you have a co-manager. You want to make sure that co-manager feels aligned. So you create a business with your co-manager, right? So I think it's important to talk about ownership. And I think oftentimes in the music, if the ownership is not with the artist or the label and it's someone outside of the ecosystem, it's typically like frowned upon.
Right. And yeah, this is why the conversation, this is why I love conversations like this. And this is why I think the podcast is finding a lot of people, because we're really getting into the weeds of what this looks like. And artists should be considering what that business looks like, to make sure that your manager doesn't feel like they're work for hire.
Exactly.
And they are incentivized with the alignment, right? Like I don't want to speak on people's businesses, but if you want to look at the biggest artists in the world right now who have consistently grown their businesses, you better believe that those people who were their managers in the beginning and maybe doing a commission basis, there was a restructuring, or there are other ventures that are partners in, so they can continue to have the best people around them. Otherwise, you're going to lose folks.
1,000%. And that's why, when I look at management, and management gets churned all the time, as in the artist, fires their manager and they're going through a whole, different set of structure. Oftentimes the devil advocate in me is like, did they get to the point too where, everything was so centralized, now it's so decentralized.
That's
The
the biggest key.
The artist needs to know what parts of the business to centralize.
Yes.
Because you went from massive centralization to massive decentralization, where you have all the different angles and you can structure all the different businesses. And it's a very confusing process for the artist to understand the nuts and bolts of corporate structure.
Yeah.
And do it in a way that's ethically, what I mean? With, and that's where I think a lot of the problems happen, is because there isn't that sort of direct dialogue between the artist, the manager, the business manager, et cetera,
So how do you do it ethically, and how are you clearing those conflict of interest?
Yeah. So, I mean, if you have a client, right, and let's say you have an artist and a client that produce on that record, and, there's obviously a splits conversation, right?
Yeah.
I don't get involved in that. I have to bring in both of their legal, which are independent,
Yeah.
to resolve that situation, right?
Right.
Because I have to make sure that I'm looking at the best interest of my clients. And the best interest for me is not do anything at all.
Mm.
And just make sure that the accounting and sort of the finance aspect is taken care of, but the negotiating has to be done outside the scope.
That's a great example.
Yeah.
So all these things, were you learning this before you got to Neon 16? Because I'd love to know, like, what is it that prepared you to get to this place?
I was in the tech world. Like I used to advise like Goldman Sachs, Charles Schwab's on sort of the digital technology and M&A space.
Flex on them.
So I didn't come from like a traditional textbook business experience, music business experience. I came from a very external environment. I mean, I love music, growing up, and I've worked with a lot of local people in the city to help them structure the businesses behind closed doors. But, just double clicking and understanding corporate structure was like, yo, why can't I bring this to the music business, which, has historically been very disorganized, right? And can I provide some sort of organization and structure for them? And then when I double clicked on that, I ended up falling into and ended up being a great candidate for that. And it served as a launching pad for, when I was working with Lex and Neon to structure all the different business units. Like that was my military training. And, I always thank Lex I always tell Lex, like, I wouldn't be here without Lex's guidance and oversight because, when you work with a Lex Barrero, it's really military grade style training. Like I learned more in those 3 years at Neon than I ever learned in my life.
Really?
Yeah.
Okay.
From working with different partners to different labels to different distributors to different admin to working on film licensing to working on agency deals. Like it was an incubator for talent, And I often think when I look at Neon, you know what the PayPal mafia is?
Yeah, of course.
I would say that Neon 16 reminds me of like the PayPal mafia because it just created superstars from talent, but also super towers from the executive standpoint.
Yeah. What's the PayPal mafia? Who's in that? Just for people to know, it's like
Peter Thiel, Elon Musk.
Yeah.
I think Rick. I think the guy who started LinkedIn,
Reid Hoffman.
Reid Hoffman. So it just was an incubator for just being able to go on to my next chapter, and I wouldn't be here today if it wasn't for the guidance and oversight of Lex.
And I know he's phenomenal. Training grounds for yourself, and amazing to see all these different things that he does, and I think a lot of people kind of think about that. No, for example, with me in my time, people are like, yo, you're doing so many different things, but it seems like that. But there's a lot of systems and process that comes into play to make sure that you can be visible everywhere and doing things at maximum effort. How are you talking to an artist to do that, to be able to scale and grow their business? But there's only so many hours in a day.
Yeah, for sure. Well, I think a big pain point is that an artist starts moving and then there's a lot of vendors that need to be paid.
Yeah.
And the traditional back office accountant won't do that because they just do year-end taxes. So you kind of seek a business manager. I never wanted to become a business manager. I worked with clients and knew that they had a lack of structure and I provided recommendations. And then they're like, yo, do you want to be my business manager? Like I never sought it out, So I think for me, it's just like looking at clients' businesses, right? Because I am prospecting, right? I don't have an open book where I'm taking 20, 30 clients. I'm a very quality person. I like to understand how people's businesses are run and see if I have any sort of value that I can add. And if I can add value, then I'll provide my recommendations. And if they choose to accept it, then I think that's when it's like, yo, like, I think you should be my business manager. It's never me knocking on doors. It's more so me getting to know artists' business. I'm the curious person to be like, okay, like, yo, how are you structuring your trademarks? How are you licensing your music? Are you collecting on all your royalties? And those conversations serve as a double click to be like, wow, like, I need you on my team.
Right.
Yeah.
So how do you get paid? Like, what's your monthly fee for this stuff?
It depends. There's so many models. There's a fixed fee model, right? Where like you have recurring revenue because a client's scope is so limited, right? Just a fixed fee. Oh, yo, I just want to make sure my IP is assigned, my IP is registered. You make sure that, all syncs are covered. But then there's also the commission-based model, right? And I think where this is going towards is that, when I build a client's business to 20, 30, 40, 50 million plus, oftentimes what happens is that the artist will want to start their own family office or, mini family office and essentially bring me on as potentially as a partner / operator for their finances and their businesses. So it's really all over the place. There's clients I work with, I don't charge them a penny because we're not there yet, and I want to make sure that they get their nuts and bolts correct before, it's better for them to reinvest their cash flows into their business, for me to just take out a fee right now. But I know that I have that sort of long-term outlook that this client, this artist, this producer is going to be a superstar.
Yeah. And you're building social capital with that person as well. And
1,000%. And my point of entry is there's a client I'm working with. He was struggling to get a visa. And I've done 100 visa applications in the last 3 years. So I know, okay, you want your P2, you want your O1, you want your TN visa. I'll connect those dots for you. And then they'll be like, yo, what I always, nah, I want to make sure you're good, because if you can, as Canadians, we struggle with the thing that we're beside the world's biggest economy.
Yeah.
At the same time, we can't open up a business there. So
right.
Just giving them that opportunity to be able to commission and earn money in the US, the same way I had the opportunity to sort of, live in Miami for 3 years and Lex taking care of my visa. I want to give that back to other creatives as well.
That's dope. How are you, can you walk me through what your monthly and annual reporting processes look like?
Yeah, so each client is very different, but for the most part, in a traditional, all the nuts and bolts are checked off, is first, you want to reconcile credit cards to make sure that all the expenses are correct. Artists have this really big thing where, they'll give their credit card to their tour manager, they'll give their credit card to their personal assistant, they'll give their credit card to their mom. You know what I mean? And you just want to make sure that all the expenses are reasonable for the business. So I think it's just reviewing all of the, expenses, for example. That's step number one, right? To make sure that everything's caught, right? And then, when a client is sharing a card for across multiple parties, I'll be like, yo, let's use a credit card system like Rippling, like Flow Canada, which allows you free of charge to implement a credit card system so you can track expenses by person, right? So now it allows me to increase and refine my reporting process, right? So that's one side of it, on the expenses side.
And you're doing this with the artist and the manager?
Yeah, artist and manager. And I implemented in everything. And I'm like, yo, you need to understand what the tour manager is spending on flights. You need to understand if the artist manager is taking some costs because, they're buying their boots on the ground and they're buying something for a video shoot. You want to make sure what they're buying, right? So you can run that report and you have that sort of detailed analysis of what that employee, partner, tour manager is spending, So that's step number one, really silo out expenses. The second side of it too is just maximizing revenues, right? So, okay, you have 100 songs out, but 20 of those songs are unregistered. What am I doing to register those songs to sort of backdate and collect those revenues to make sure that I'm actually increasing your revenue base too?
Mm-hmm.
So that's my process. Understand expenses, make sure the bookkeeping is done, and then on the revenue side, making sure that you're collecting on all revenues. And if there's missing revenues, what am I doing to reverse engineer collection?
So if there's uncollected revenues, or for example, some fraud is happening or mismanagement of that, how are you mitigating those risks?
So the US has actually made it very easy because if you have a Chase bank account, if you have, the industry standard in banking for entertainment is City National Bank owned by RBC. So they call it CNB. So CNB allows you to apply dual authentication, right? So, if you're my client and I have access to your personal banking, you can apply very specific limits. And also,
let's take my issue, for example, if we want to go and have that conversation. So using my stuff as an example.
Yeah, so perfect example. We're building your finance infrastructure right now, right? We have one account login, right?
Mm-hmm.
But every time I log in or every time I do a wire, I have to say, Mauricio, I need a text message.
Yep.
I'm paying this out, right? That's the very junior entry level. But as this relationship evolves, which hopefully it does, we essentially will have more robust banking needs, right? Where it's if payments under, we define our rules. Hey, Dan, any payments under 5K, you have sort of, the right to do that. Any payments from 5 to 10K will require two-factor authentication. Any payments above 10,000, only I have final sign-off. And this is a rapport that we have to build as we sort of keep on working together.
Yeah, because at the end of the day, this podcast is, it's been a little over a year, but it's still a very junior business.
1,000%. So, and then as you evolve and, as we set up your structure in the US, for example, you realize that, that's part of the plan as well to make sure that, there's payments and compliance, given, we operate and we live in the US for, a big part of the year as well too.
So how are you also managing cash flow for artists or creators, content creators, podcasters that have inconsistent income?
So the first point is like, if I'm picking up a client, I need to understand their cash flows historically. Like, how do they earn money, at what rate, etc. Because at the end of the day, the entrepreneur, the person running the business, needs to get paid something, right? So just audit the financials. If people that are on publishing deals, they get paid out quarterly, right?
Right.
If you have master distribution, you get paid out monthly if you're self-distributed. If you're in the business of producer management, it takes a lot of time to collect your producer fee.
Yeah.
It knock on doors and this and that too.
Yeah.
So you want to have like, a reserve, whether it's 3 months, 6 months, whatever we're working with after I sort of analyze the business, to make sure that you're good for that sort of 6-month life cycle, so that when it comes to chasing, accounts receivable, you're good. And then I would pay my client a salary. Like, yo, listen,
based off of that,
based off of what your historical cash flows are. And at quarter end or at year end, if you want to bonus yourself out, you bonus yourself out because you understood your cash flows.
Yeah. So we were talking about, you analyze the cash flow, which a lot of people call runway.
Runway, yeah.
Right. Like that's another term for it. 6 months. Analyze that. Then we base what does your cost of living look like and all that. And based off of that, this is what we're going to pay you. Make sure that you can earn a living, and then make sure that your business expenses aren't exceeding, but
1,000%. Yeah. And a lot of times too is like, let's say you're an artist, you're living in Miami, you're paying $5,000 for an apartment. I'm like, you don't need to live in that $5,000 apartment.
Yeah. So how do you have that conversation with somebody who feels comfortable with that?
I would just say, hey, listen, based off my experience, the way you're spending money is not the right way to spend your money. And I think that if you want to build a sustainable business, you need to revalue your personal finances.
Yeah.
And I think that's a super honest conversation. I have no shame in saying like, like this is an us conversation. Like this is me trying to help you, right?
Yeah.
And you have to have those honest conversations. Or, you look at, you're spending $3,000 a month on, Uber Eats. It's like, bro, like, let's figure out a better system. Let's do meal prep. It's like these small micro actions that just add up and accumulate.
And you're getting into the weeds with those.
1,000%. Because everyone has their own lifestyle. And like, I'm not trying to change their lifestyle. I'm trying to work within their parameters and make sure that they feel good about, the change. Because if you ask an artist to make a big and significant change, I become the most hated guy,
Yeah.
But if I kind of present them options, hey, you're doing this, but have you explored this, and that, and give them that optionality, it actually makes the conversation a lot more digestible.
How do you communicate with clients? What's the frequency? What's the format? Who's the day-to-day? Would it be you, somebody within your team?
So it's different styles for different engagements, right? There's ones where I'm point lead on day-to-day conversations. There's one where I do a monthly check-in or a bi-weekly check-in. There's ones where some people just want bookkeeping and expenses paid at a month end. So business managers have different entry points for different things. And as that relationship changes and, everyone has their own team dynamic, right? So like sometimes the manager is more boots on the ground and they have a finance background and, they can do budgets. It's like, okay, now I just got to validate your budget and provide you some sort of my POV and analysis. I'm not creating the budget for you, So it really depends. Like, I think there's options for day-to-day interaction. There's also options where we do a bi-weekly, bi-monthly check-in. There's also options too where it's like once a month you're just paying your bills, Can
you provide examples of how you've grown an artist's network versus just protecting it?
I think, a big example is royalty collection, specifically miscollection on royalties. I've worked with artists that have never once collected on their publishing, like independent artists that never once collected on their publishing.
Wow.
And I can kind of just use as a proxy. I'm like, yo, they have 100, 200, 300, 500K uncollected royalties. And then you start the investigations with the PROs, you start the investigations with the MLC, and then you find them like this little bunch of money. And to them, it's like, wow, I just found like, a cookie, like I want to eat it, And it's like, nah, like let's find a way to reallocate these funds to earn dividends, right? So, in terms of retaining wealth, it would either be to like, find a wealth manager to invest that money for you, what I mean? And earn yield on that.
Right. Speaking of wealth, and this is a term that you use when you come from the tech world, and it's used quite a bit, but raising capital.
Mm-hmm.
What's your take on that when it comes to raising capital for an artist, let's say, or a producer, or somebody who has an idea and they just really have an idea and they want to raise X amount of dollars?
Raising capital has historically been done by the majors, right? Like on a traditional label deal, on a JV deal. But now with music becoming such a mature asset class, is that there's capital outside of that ecosystem. And it's good and it's bad. It's good because it allows you to have optionality. It's bad because most managers and artists don't understand the world of how dingy private equity can be, right?
Yeah.
Like, when you do these deals with private equity, they look at this term called like EBITDA, right?
Yes.
Like we want to make sure your EBITDA is grown by 2x, 3x, 4x. And EBITDA is just a fancy word for saying like your profitability. It stands for earnings before interest, tax, depreciation, amortization.
Yeah. Everybody
Right?
got to think about yeah.
Right. So now you're working with bankers as opposed to people who are underwriting in the music scene. Right?
Yeah.
But if you know how to negotiate and you know how to underwrite it, you can actually get more favorable terms than the traditional label system.
So how do you go about doing that? So say an artist wants to come to you,
Yeah.
they're like, listen, I want to raise $5 million of capital. What are the steps?
I would say when I raise money for my tech company, I would say I put a pitch deck together. I had a CFO, I had a COO, I had a CTO. So what does your team look like, right? Because we're building off your vision. You are the North Star of the product. But what does your team look like? What is the relationship with capital, right? Because in this business, we're notorious for an artist getting $1 million advance. And after they get the first $1 million, they buy watches, cars, houses, help their friends out, etc. You can't do that in the private equity world.
Right.
If you do that, you will literally never raise again.
Yeah.
Right?
Yeah.
So the way I kind of look at it is like, if you want to raise capital and benefit from the capital markets ecosystem outside the traditional label ecosystem, you need to invest. Your business manager is no longer a business manager. It's like you need a CFO, COO, someone that can essentially communicate your vision with the right financial support and the right pitch deck and do the traditional VC private equity pitch.
But are you doing a PE and VC pitch when you're, it's an immature business? It's just an idea?
No, I would say that the best time that artists do it is when they're at a point where they don't want to be in the traditional label system anymore because the financing terms aren't as great. They want more fluidity and creativity and be able to take matters on their own. And you kind of start exploring what the market has to offer with external parties. Where like there's some parties out there, some investors that are just cut you the check and will let you operate your business as is. There's other private equity partners that, they're going to take a stake in the company, but in 3 years they want a controlling stake, right? So you have to be able to paint out all the scenarios, the label system scenarios, the non-label system scenarios, the private equity scenarios, and just weigh out all the pros and cons that just means the most to the artist and communicate that. Because everyone can say they'll cut a $10 million check, but what are the nuts and bolts behind that purchase sale agreement? Like what are the covenants you're signing? What rights do you give up? You know what I mean? And that's what's important.
What are you looking at? What do you think are typically the best type of deals that somebody should be doing, or like the best type of capital that they should?
I think the best thing you can do is find a partner that you're aligned with.
Yeah.
Because if you're building out a 10-year business, but your partner has a 5-year outlook, you cannot deliver on that promise, and you're going to create. It's going to
conflict.
It's going to create a bad marriage.
Yeah.
Right. Whereas a label, like their sales cycle is 10, 20 years to recoup sometimes, right? So they'll give you the advance, but there's high financing terms associated with that, right? So I think it's just matching the expectation between the buyer versus the seller.
What's your process for evaluating this?
Valuation has become a very subjective thing in the sense that, if you have historical data, you can base it off historical data. But this is the only business in the world where we're selling the subjective. We're not selling the objective.
Yeah.
If I'm a car manufacturer and I have 10,000 widgets and I know China needs widgets, I'm going to sell to China. It's the only business where you can deliver a product. It can literally be received and digested by no one. And then they don't love it, And that's the hard part of this business, is communicating this objective to say that, yes, there's going to be a lot of strikes, but after 10 or 20, I'm going to get 1 or 2 big ones. And that's the premise of trying to raise capital in this music business.
Interesting. So in order to do that, you have to have people who are going to invest capital who actually understand that, right?
Understand the language of the private equity investor, because in understanding runway and understanding all these important terms, because, a private equity firm will say, hey, we'll buy you right now for a 6, 7, 8x EBITDA multiple. It's just another fancy word for saying 6 to 7 to 8 times of profits. Whatever you're earning,
Yes.
you multiply it. And then you realize that a year 4, year 5, because you took that cash flow and you're reinvesting everything back into that business, you might have little to zero EBITDA. And they actually might be able to buy the remaining of your business for pennies on the dollar. And that's a very common thing in private equity. Like, it's always the earnouts are always tied to future EBITDA multiples. And most artists, that is like rocket science to them. So being able to communicate that to them and showing them what that earnout scenario looks like and providing that scenario analysis is why the needs and sort of the evolution of the business manager is becoming such a hot role right now, if you will.
Okay, so manager.
Yeah.
Rocket science, you just told me right now, right? So what's like a simplified way to explain that? That the EBITDA, and then, you're not getting like pennies on a dollar if you're not meeting the requirements necessary.
Yeah. So if you're making $1 million a year,
yes,
right? You come in, you're making $1 million a year. You earn a combination from, let's say, IP from master, IP from publishing. You have some catalog you've developed. It's making $1 million in cash flow per year. A private equity be like, yo, I'm going to value your company anywhere from, let's say, $7 to $10 million. Because you're in that 7 to 10 EBITDA multiple, right?
Yeah.
You take a $2.5 million check, they now own 25% of your company because you're valued at, let's say, $10 million. Now, within that valuation, they also need to recoup their investment first. When you do VC or private equity money, they issue something called preferred stock. So there's common stock and preferred stock. So it says that anyone who put money into the business actually recoups and has a liquidation preference prior to the common shareholders paying out. So most people don't know that. Like, okay, yeah, they're investing into their company, but if the company liquidates for $2 million, the investors get their $2 million back first, and then the company dissolves.
Right.
And so those are the type of things. And then now it's become so robust where, private equity wants to have a controlling interest. So they'll be like, we'll buy something today at XYZ EBITDA. We'll buy something in 5, 10 years for another EBITDA. And now you have to play an EBITDA game to maximize EBITDA, which might not be the best sort of value for your business at this very moment, but you're locked into a price in the future determined today. So you could essentially, you're maximizing profit, but not necessarily maximizing value for your brand and for your business, because you might have a contract that's coming in 2 years from there,
Right. So there's a conflict there, inherent conflict.
Inherent conflict.
So how often when you have private equity coming in, so what's the vice versa of that? How important is it for these institutions or these organizations or these family offices to understand how the music business is operating and who could be the right partner for the marriage?
I think what we've seen is that a lot of private equity firms say now that they're interested in music.
Yes.
But they don't understand the life cycle of how revenue recognition, which is just a very technical term for understanding how revenues flow within the business. So, for example, I've worked with private equity firms that they don't understand the black box context, where I'm like, hey, I'm pitching an artist, I'm pitching a producer, and I'm like, hey, he's earning $200K in revenues, but I think he has approximately $150K of black box revenues earned, which would bring us all in revenue to $350,000. I'm going to base that multiple on that because it's uncollected royalties.
Yes.
It's like rocket science for them. Oh, what's black box? What's MLC? What's, PRO? So traditional private equity firms struggle with that, right? It's more so betting on, a solid finance team. Oh, Dan has a background in a CFO. He has royalty experience. He has valuation experience. We're going to trust this team because Daniel's paired up with, this most amazing artist that's moving the needle culturally right now. That's one aspect of it. The second capital allocators are boutiques that actually focus on this business. And sometimes, they, I would say they're more involved in the business, but that could be a good thing or that could be a bad thing because, if it's not broken, why fix it, right?
Yeah.
So there's no right or wrong strategy. I think it just depends on what your value system is of what you're looking for in a partner.
And I appreciate your value system, man. This has been an amazing conversation. A couple more questions before we get out of here. But I mean, what advice would you give your 20-year-old self?
I would say, man, just, there's this relationship between mentorship or sort of education. I don't like people say the word mentor and they have a negative connotation towards it, but just seek someone that you can find. Because people were like, mentors are overrated. Like there's this whole concept that's going on about mentorship. Like seek someone that you can, it doesn't have to be like a formal thing. Just seek someone that you can, seek people that you can seek education from.
Yeah.
Like that's so imperative.
Absolutely. Yeah.
Like, ask questions, right?
Yeah.
The more I've grown into this business, and I'm only 29 right now, you realize that a lot of people do not know what they're doing.
Totally.
And that's, and it also reassures that like, oh, you're figuring things out just like they're figuring things out.
Yeah, absolutely.
And that's a good thing. And also like education has become so accessible. Like, you can literally ask ChatGPT, explain to me what publishing reversion is, explain to me what master is, what PPD is. There's Donald Passman's book, which is, if that's too technical for it, like you can literally ask ChatGPT to summarize a section for you. You know what I mean? You can watch the Manager's Playbook podcast, which literally decomposes all of these amazing topics about marketing, about A&R, about publishing, about producer management, about working with a global superstar, building businesses, the manager-artist relationship, co-management versus management. So all these topics now is literally accessible online. I think it's platforms like yours that provide a mouthpiece for the next generation of artists, producers, and also real-time executives that are interested in learning about other aspects of the business, because I may be very well versed in business management, but I am not the best creative. So being able to, look at a platform like yours just allows me to allow how other people think about problems.
Yeah, and I think that's a form of mentorship as well. It doesn't necessarily have to be the one-to-one transaction.
Correct. That's what I meant. Yeah.
Yeah, absolutely. And I've seeked out mentors or whatever you want to call them, relationships, just to be educated myself through my entire career. And a lot of the times, actually, the mentors who I've seeked out from, sometimes they're like 5 or 10 years younger than me.
Yeah.
It doesn't necessarily have to be somebody older, because the older guard might have traditional ways of looking at things that are, I wouldn't say antiquated, but they're just not the way it's being delivered right now in a decentralized world like you're talking about.
Yeah. And one thing I think that a lot of people don't do now, which, I think has worked wonders for me, is that I have no problem calling SoCan. I have no problem calling
Yeah,
MLC.
me either. Yeah.
I have no problem calling people and being the charmfully annoying person to be like, yo, give me a point of contact, because I'm literally going to get so frustrated if you put me to the same processing machine. So just having a point of contact, and you can literally do that by creating and cold emailing systems and just double clicking, and then you have a point of contact. So now when you have an issue, you can just call that person. Hey, by the way, I registered this song on SoCan. Can you please determine what my black spot earnings period is?
Yeah.
Okay, cool. Because you registered the song late, because I was figuring out something for a client, we can only go back XYZ. Cool. What do I got to do to earn that money then? Oh, okay, in 2 quarters, you should see that statement. Cool. Second quarter comes in, not received it. Oh, there was a delay on the registration on our side. Next quarter.
Yeah.
Next quarter comes in. Okay, cool. I got the money for the previous 2 quarters. I go to the statement. I validate it. And it's just being charmfully annoying. Like, that's how you get here,
Yeah, absolutely. Yeah, no problem doing that. And the funny thing about it is, a lot of people assume that people don't want to help you, but in this business, people do want to actually help you, especially if you come at it with a good approach. If you're positive in the interaction, nobody wants to deal with somebody who's an asshole. But if you're actually just, because you need to figure these things out, there are people who will help you with these organizations.
And, I think also too, artists are so scared sometimes to ask questions.
Because they feel like they will come off as if they're not smart.
Yeah. And I'm like, I work for you, know, so you can ask me as many questions as you want, technical, non-technical, anything you want to learn about the business. And the whole premise is that because the information has become so accessible outside of, everything used to be within the wall of certain compounds, Now everything's so accessible. It's like, I'm an open book with respect to the knowledge that I've acquired because it's already available. So there's nothing for me to lose to just disclose it to you.
That's a fact. Last question before we get out of here. Gotta ask you this, and I ask this to most of my guests. Sometimes I forget. 3 books that you would recommend for anybody watching this pod. Doesn't have to be about the music business or not, but 3 books that you would recommend.
I mean, I like my first entry point was Donald Passman's book.
Yes.
Like when I was 21, 22, figuring out this music stuff. And that book is hard to read, man. Like
It's
as
dense.
much as it is so educational, it's one of those books that like I still pick it up to this day
Me too.
and refer back to sort of the like legalese of certain things. And because the music, like the MLC wasn't, there was Harry Fox and there was MLC. So there's a lot of regulatory change and compliance that's happening. So I always refer back to it just to stay up to date from like a corporate compliance standpoint.
Yeah.
I would say How to Win Friends and Influence People.
And so people, that's a good book actually. Just so people know, the Donald Passman book that he's talking about is All You Need to Know About the Music Business.
Correct.
So How to Win Friends and Influence People is, who's that by again?
I read that in like 5 years ago.
Dale Carnegie?
Yeah. And then it's funny, I went on a cruise last week and then my girl gave me that book, started reading it again too. And it was just like, it was such a good refresher.
Yes.
And I
gotta read that again.
And I think I also love like Atomic Habits. I think that's the one.
It's one of my favorites.
Yeah, Atomic Habits.
Yeah.
So like,
I'm just rereading it again right now.
I don't read a lot of fiction stuff. I'm a very big nonfiction. How do I keep on, learning about myself, my spirituality, like just things for me to just learn outside of, fictionalized content. So.
Dan, this has been an amazing conversation, man. I appreciate your time.
Thank you, brother.
Thank you so much, bro. All right, I think a lot of people are going to learn a lot from this. There's a lot of value in this conversation. Thank you for doing this. I mean, I learned a lot over here. A lot of people, the one thing that I love about this podcast that we're doing and that we're building and that you're on the team and building and hopefully grow to be, a major staple in the community and just a business. But the one thing that I love about this more than anything else is that I get to learn just as much as the audience at home, man. So thank you so much for this, brother.
Of course, brother. Thank you.